morning, traders. Not a particularly great picture to be looking at today. I mean, we've been very focused on what's been happening in credit markets as your guide for equity markets. I've been talking about that in my afternoon note, the Daily Fix. So, certainly reach out if you want to be on that list. But certainly high yield credit spreads continue to widen versus investment grade credit, and also what we've been seeing in US Treasuries, that so-called risk-free rate. And I think equities definitely taking their guide from that side of things. And equities don't really need much of a guide in the first place because they've got all sorts of problems in tech, where we've seen Apple really showing that downside leadership. Where the stocks dropped 24% from the October highs. People obviously very concerned with what's happening in supply chains, what's happening for the future of iPhone sales, and what's the outlook for the company? What is the right multiple for this stock in this market? Of course, equities more broadly need to have a higher risk premium being priced in because the macro is so uncertain at the moment. We are seeing a slowdown in certain economic data points in the US, and we can focus now on what's happening in global markets as well. And there's no doubt that the Fed have turned to a much more neutral view. Certain core members of the Fed have given a more nuanced view and acknowledged some of the risks. And that really came after last week's Fed senior loan officers survey that came through showing a big deterioration in bank lending, which I think is got overlooked a little bit by the market. And I think that's something that we are focused on there. But I think as well we can look at Asian markets as well. And yesterday we saw this big deterioration in equity, and that's after a little bit of a reprieve coming through after the Chinese government and various authorities chucked a ton of stimulus at the equity markets and trying to increase liquidity there and prop up prices, but also a number of measures which have been aimed to try and boost consumption there. We had a bit of a move up, but yesterday the Shenzhen Composite was down about 2.7%. The more sort of actively traded Hang Seng and the CSI 300 were down about 2% or so. And of course, in that scenario, we are wondering whether there's further downside in the Chinese markets. I think the catalyst behind that was commentary from the head of research at the PBOC, who suggested that economic downside had intensified within China, and of course no one's really going to like that situation. If you have a look at the Aussie dollar, it's been heavily beaten up overnight. I think we have seen some sort of constructive rhetoric on global trade, and I think the Aussie dollar was probably a really good poster child of that. We had suggested that after the close above 73.04 on a weekly basis that perhaps we can see a longer term squeeze up to 74.5 cents. That hasn't necessarily traded out, and obviously we've seen a reversal, and I think that correlation between the Aussie dollar and the Hang Seng, which has got the strongest correlation coefficient on a 6-month basis, has picked up again. So we are watching what's happening in the Hang Seng there, but the fact that those markets have moved down and those new comments from the PBOC is something that has concerned us a little bit. We've reduced that position, and we're just watching to see how it acts around that sort of 71.60 level, a break at that level, and then obviously you're out of the trade. I think you'd probably be going much lower in the Aussie dollar again in that scenario, and that would be intensified by a big sell down in Chinese markets. So we are watching that situation. Of course, one of the big talking points on the floor is what's happening in oil prices. So, dollar CAD, which we had been expecting a little bit more of a move down, has gone completely the opposite way. The Canadian dollar and the NOK and the petro currencies have been smashed on the back of what's been happening in the Brent price and also the US crude price. US crude, if we take that, it's certainly more actively traded by clients. Has seen a near 7% move on the session. It may see some upside in the short term because the API inventory numbers, which of course are a precursor to tonight's Department of Energy ones, came out with just over 1 million barrel draw. The market probably gone in expecting another build, but that hasn't happened. So probably the consensus for tonight's Department of Energy numbers, which is looking for a sort of 2.5 million barrel build, I think probably there are some downside there. But of course we are very concerned with what's happening in supply. If you've been looking at what's been happening in Iran, there's been a number of waivers there which have increased the idea that perhaps we're not going to see production coming lower from Iran, and other countries are going to make up the shortfall. There'd been some speculation that perhaps Libya and Nigeria, there'd be some production issues coming through some of their oil fields. That hasn't happened. And at the end of the day, we've got record production in a number of the key oil producing nations such as Saudi Arabia and also in the US as well. And of course, we are wondering whether there's going to be production cuts, specifically from OPEC nations. Now, last week they did float the idea that we could potentially see 500,000 barrels a day being cut from the oil price. After those sort of wishy-washy comments, we haven't heard too much. The market wants to hear real meat on the bone as we go into the 6th of December OPEC meeting. And I think that's really key. You've got to have that on your radar now, because I think that's an absolutely pivotal event. If we're looking at events, the 6th of December now is one that's going to be a really defining moment there. The fact that we did see Russia as well coming out on Sunday and saying, we are kind of on board with production cuts, but let's just see how this all plays out. Let's see how the markets react. and then perhaps we could be on board. Again, they haven't really given us any clear indication that they want to continue with their production agreement that we saw back in 2016 between the OPEC nations and 11 non-OPEC nations as well. So the fact that Russia aren't necessarily on board is one issue as well. Again, we can focus on Donald Trump, who's talked down the oil price, saying he would like to see a lower oil price, and also coming out and working with the Saudis. And suggesting also that the Saudis could be manipulating the price and keeping it suppressed, and that's definitely an issue. But I think at the moment we've got all eyes on what's happening on the supply side of situations. Demand's not particularly great. We have seen a number of agencies looking to cut back on their expected demand for 2019, 2020 as well. And of course, global growth is something that's very much in focus as well. But it's supply that's really going to cause the move higher. If we do see real meat on the bone that we are going to see production cuts, then perhaps we can push back into the high 50s in US crude. But that meeting now, I think, will determine whether we see oil prices $10 to $15 lower or $10 to $15 higher over the sort of next month. And I think it's interesting if we look at implied vol in Brent and US crude, and we specifically look at the expiry that just sort of bypasses the 6th of December meeting, then implied vols are very, very high. And in fact, if you're looking at Brent prices, the markets have got an implied move through sort of mid-December of about $7.30, $7.50 or so. So we are expecting continued volatility playing through in the oil price. And for me as a macro watcher, that's very important because equities are quite correlated to oil. If that continues to fall, so will equities, in my opinion. And also, I think really importantly is that inflation expectations are getting badly beaten up as well. If you look at 5-year break-evens or the bond market's expected inflation over a period, that's sitting at 1.83%. Go back to October, that was well above 2% at the moment. So inflation expectations around the world have been falling in bond markets. That's boosting real yields, which is tightening of financial conditions. So I think that's definitely what we're watching. The talk at the moment is what's happening in oil. I think it's a culmination of various factors, but the supply dynamic needs to be changed. It needs to come from OPEC, and that's why we are watching that 6th of December meeting and the noises that are going to be made going into that.